So do I think the price of gold is going to a trillion or a quadrillion like it did in Weimar, Germany? I think it won't get to that. It could go a lot higher than we're now, and I think it will. I don't know the price. And I think the dollar and the rest of its minions, other fiat currencies, they will be toast when you can't get any more gold or silver with them.
As long as fiat currencies are being used to transact business, over time, it takes more currency to purchase the same amount of a commodity. And that's not going to change because the currencies aren't backed by anything except faith in the government. They're not on the gold standard. That's long past, that train is run and past the station, so to speak.
Gold's rally is fueled in part by unprecedented official sector buying as countries diversify away from U.S. dollar reserves. According to the International Monetary Fund, central bank holdings of physical gold in emerging markets have risen 161% since 2006 to around 10,300 tons. To put this into perspective, emerging market gold holdings grew by only 50% over the 50 years to 2005. Market analysts MarioInnecco and GaryWagner offer valuable insights into the unfolding precious metals surge. In this video, MarioInnecco argues that the surge in gold and silver prices is about the rapid decline of fiat currencies. He links this trend to years of unchecked monetary expansion and inflation, comparing the dollar's current path to Germany's 1920s hyperinflation. In 1979, amid double-digit inflation numbers in the United States and a global energy crisis, investors stocked up on the precious metal as a way to counter those shocks. In the years following the 2008 financial crisis, as investors lost trust in major institutions once seen as too big to fail, gold prices shot up again. And when persistent inflation was crushing the US dollar after the coronavirus pandemic in 2020, gold once again soared. From a technical perspective, Innecco also points to rising interest in gold and silver across the globe, from retail investors in the UK to a growing wave of buyers in Japan. Meanwhile, non-Western central banks quietly expand their gold reserves. Similarly, China has steadily accumulated gold while developing alternative payment systems and promoting the internationalization of the yuan. China has reported consecutive months of gold purchases from November 2022 through May 2024. As of September 2024, official reserves have reached 2,264 tons, though many analysts believe actual holdings exceed official reports. Before we dive into MarioInnecco and GaryWagner's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
What I'm gonna try to do today is show you what I think is happening, why gold is going up and silver. And of course, it's not really gold and silver going up, it's the currencies going down, and that's what I'm gonna tell you. Of course, I've been warning about this for many years. I have a hyperinflation file on the channel, on my YouTube channel. It's got like 77 videos, I think. I'm gonna put this one in it. And I'm gonna show you a chart today that I've used many times from the 1923 or early 1920s collapse of the Reichsmark, comparing it to the present day dollar. And looking here at my hyperinflation files, it looks like I've been warning about this chart ever since March last year, because the current or the gold chart at the time looked very similar and has continued to match it, which is really worrying, I would say, for the monetary authorities and for those who have no gold or silver whatsoever. And unfortunately, I think a lot of people are not going to get gold and silver because they're always told that it's too expensive, that it's too high, that it's too risky, right? And they always put it off. I mean, I know dozens of people that I've spoken to, and they come back to me and they say, you were right, I haven't bought it yet, I should have bought it. But that's the way things are. And of course, I've been talking about this as well, this editorial from the FT. So you have to take whatever the FT tells you today or tomorrow or in these times about gold with a pinch of salt or a big chunk of salt, because back in 04 they were saying that gold was no good, that it was pointless to hold bullion, and at the time the gold price was $400. So there you go, that's the FT for you. What I am going to do today is refer to Ludwig von Mises, the giant of the Austrian School of Economics, along with Friedrich von Hayek and others, of course. And we're going to look at what he called the crack-up boom. And I've been asking this question for the last few years. Are we there yet? And I think we are in it, actually. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. So I think gold is more, right now, it's not like in the 2000s. It's more of a fear trade. It's not FOMO. It's not fear of missing out. It's not greed. It's fear of the rapidly depreciating fiat currency values. And the very wealthy don't really feel it because they're comfortable. They don't care about restaurant prices, food prices, or utility prices going up, because they probably don't even pay it themselves. They have people who work for them who take care of it. They're not concerned about it, but the general public is. They're seeing that everything is going through the roof, that their currency is not buying as much, right? Within a very short time, within a few weeks or even days, the things which were used as money are no longer used as media of exchange. They become scrap paper or scrap digital entries nowadays. Nobody wants to give anything away against them. So he says here, within a very short time, within a few weeks or even days, do I think this is going to play out like that? I think it could, but looking at this chart here that I'm going to show you now, comparing what happened in Germany in the 1920s, you can see that it's a shorter period chart than we have now for the dollar. So things happen quicker. But one thing I would say, when people wake up, the crack-up boom or hyperinflation, loss of confidence, the loss of confidence in the currency happens overnight. So yes, it might take longer in the lead up to that loss of confidence, and I think it's difficult to say when it will be. But once it happens, you won't be able to get gold or silver for the currency. That's why it's so important to still, in my opinion, try to get out of fiat currency while you can. And hopefully many of you have done that and have been doing for years, because we've been talking about this for years. Let's continue with the crack-up boom. It was this that happened with the continental currency in America in 1781. So yeah, it has happened before in the United States, but it was a very long time ago. That's why most people don't think it can happen again. With the French mandats territoriaux in 1796, I would add also the assignats to that. The mandats territoriaux, that currency that came after the assignats, they didn't even issue it. It just collapsed before it was issued. and with the German mark in 1923. It will happen again when the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. Yes, and they do talk about the debt in the FT article, but still, they don't talk about hyperinflation or the crack up boom. So do I think the price of gold is going to a trillion or a quadrillion like it did in Weimar, Germany? It could go a lot higher than we're now, and I think it will. I don't know the price, and I think the dollar and the rest of its minions, other fiat currencies, they will be toast when you can't get any more gold or silver with them. And then they'll have to, they don't have to, but they'll probably will. The powers that be will try to drum up some new system and to regain confidence. Hopefully they won't. And hopefully the free market and sound money like this, right, and gold will come back.
Regarding the current gold rally, GaryWagner highlights a strong bullish trend, with prices holding above key moving averages. He notes that while speculative inflows could prompt a short-term correction, the broader fundamentals remain robust amid a weakening US dollar. Wagner projects gold could reach $4,300 by year-end, driven by record central bank accumulation, which is tightening supply and sustaining long-term upward momentum. Central banks are increasingly viewing gold as essential for diversifying away from traditional currency reserves. With approximately 59% of global foreign exchange reserves held in US dollars as of the fourth quarter of 2023, down from over 70% in the early 2000s, many nations are seeking to reduce this concentration risk. Gold has entered a sustained breakout phase since mid-2024, with prices consistently setting new all-time highs. Unlike previous rallies that often saw significant pullbacks, the current uptrend has demonstrated remarkable resilience, with only minor corrections followed by continued upward momentum. Technical indicators like RSI occasionally signal overbought conditions, yet the market repeatedly defies these signals as fundamental demand overwhelms technical resistance. Let's get back to the interview.
Well, as you can see, we went parabolic beginning on Tuesday, the 19th of August. I have two basic simple moving averages, a 20-day simple in blue and a green, which represents a 50-day. Typically, a market technician looks at the 50-day moving average as an indication of whether or not a stock or commodity is in a bullish, bearish, or neutral trend. To be in a bullish trend, pricing must be above the 50-day moving average. Now, if we look back, there was a period of time between, call it the end of August and maybe the end of May, when it was actually price was actually oscillating in and out of that level. But for the most part, the entire year has witnessed real bullish sentiment. And the way that we can see that, of course, is the fact that the longer term 50-day is underneath the shorter term 20-day. And especially when you look at current pricing, we're looking at the distance between the two moving averages. They were very tight back around the 20th of August. They were almost together. They did not cross. And when they cross, in other words, if the market goes up and then you get the blue line crossing over the green line, that's called a dead cross. If it crosses above, it's called a bullish cross. So it's in the proper alignment for a full bullish demeanor. And the fact that these moving averages, the price distance between them is widening, that tells you that it's getting even more bullish. And that's important. We can see that in terms of how quickly prices have moved up and how wide the differential between these moving averages are getting. Mm-hmm. And that really bodes a whole lot in terms of bullish market sentiment. It continues to be bullish, and market sentiment is getting stronger. Well, the one thing that you said that alarms me is typically when the public or speculative money comes in droves into the market, it tells you there's a potential top. And even a potential top, as far as I'm concerned, would be a necessary way to kind of reset. I would look for a shallow and quick retracement and then back to a bullish demeanor. But when you get too much speculative money in, the large institutional players tend to use that as a price point to pull profits. Can happen. If the fundamentals are so overwhelmingly bullish, then speculator money doesn't really change the dynamics. But I have seen times in the past, and I've been doing this since 1980, so a few years, in which when the speculative money was rich, let's say, it's kind of like a lake filled with really big trout. And that's when the fishermen come out and cast their line. In that way, you want to be careful when you see that happening, but you can't argue with fundamentals.
Yeah.
And if the dollar continues to lose value in relationship to other currencies, but more importantly, if it loses value in terms of buying power, inflation, the one safe haven asset that historically has been an island, a bastion of safety, has been gold. It's been that way for a long time, and I don't see that changing. Personally, I think that we are headed right now, short term, meaning by the end of the year, to 4,300. However, I have a caveat, and the caveat is that at any point, we could see the market correct. The correction doesn't mean that the rally is over. It simply means that there is profit taking going on in the market. The other thing that would do that, of course, is if the fundamentals change. And right now, that doesn't seem that likely. And so I would believe that gold will continue to move higher, but we could see it consolidate, form what I call a base. When we look at our chart, you can see it sort of back in the beginning of September. Gold goes to about 96.70, and then it stays in this tight range with these bottoms, which represent either the closing price or the opening price, and as high as 37.26, as low as 36.74 before it pops up again. Then you get a couple of days of consolidation. Then you get a higher price, consolidation, higher price. Not really consolidation, you have larger candles, and now we have that move back up. So because of that, I still think there is upside room. I am surprised personally that we've seen such a huge move without any sort of a correction. Well, the one thing you have to take into account with central bank accumulation of gold rather than dollars, hard currency, which was the case years ago, central banks tend to buy, accumulate, hold. They don't sell. So anytime you get a central bank accumulating more gold, that's going to stay in their reserve. They're not looking to liquidate it as much as use that as an instrument to provide value. In other words, the liquidity they need. And so it's important to note that when central banks are accumulating, they're going to hold on to it for a while. So that will diminish the supply. And of course, that will accelerate the upside move. So the fact in China, I believe, is one of the larger purchasers of gold. Even though they produce a tremendous amount, they continue to buy from the open market. And that gold will stay in the central bank of China for a long time. It's not something, they're not speculating. They're not looking to accumulate and then sell. When they buy it, they keep it. And so that will tend to tighten the supply.
Yeah.
Supply and demand economics, when supply diminishes, price can only move one way, and that's higher. And so that would be a very positive factor for gold. The more central banks are accumulating, the tighter the supply will get and the higher gold will go.
A number of reasons have been suggested to explain the current record run for gold. These include greater economic uncertainties from ballooning government debt levels and the current U.S. government shutdown. Historical data suggests gold typically performs best during periods of financial stress, but can experience significant price volatility during normal market conditions. This makes allocation size and timing critical considerations. After surging nearly 50% so far this year, gold could skyrocket 150% as early as 2028 if its current pace keeps up. Could this accelerating move toward gold mark the beginning of a long-term reset in the global financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.